Yeah, so this is one of those accounts that so many people use, but it's really kind of worthless, and you're much better off just not putting money in there. I'm Kevin Pira, a certified financial planner, and today I am tier listing a bunch of different retirement accounts out there, and we're gonna see how well they stack up against each other for the average person. Let's go. All right, starting off with the traditional 401k. So we all know the traditional 401k, right? It's such a well-known, powerful account. It's definitely going to be high on this tier list. I mean, it's made so many millionaires out there. The biggest problem I have with the traditional 401k is that, you obviously are deferring your taxes until retirement. So it's not like a Roth 401k where you take that money out and you can have those tax-free withdrawals. The biggest problem also with the traditional 401k is the RMDs, so the required minimum distributions. That's basically when the government says, hey, you got to take money out of this account or you're going to get a huge penalty on it. So, and that happens at usually 73 or 75. So that's a problem. Now, does that make it S tier or A tier? For me, it's A tier. I think the traditional 401k, especially if it could be S tier if you're a high income earner, because that current year tax deduction is going to be especially worth it. But I think for most people, probably we would be A tier, I would imagine. Outside of that, though, I mean, big deferral limits. You can, as an employee, defer $23,500 for 2025. Of course, your employer is going to throw some money in there. You get the free employer money match. That's huge. It's literally free money. So that's automatically going to earn it basically at least an A tier. So there's no reason why, it's no reason why the 401k has minted so many millionaires. It's because you're putting money into an account systematically over time. It's earning interest. It's a beautiful thing. Now, if you have a 401k that has really bad investment options, that's a problem. However, I think most plans are, administered on a fiduciary basis, so they're usually pretty good about that. So I think the 401k, let's give it a solid A tier. Brokerage account. Okay, so brokerage accounts. This is just your normal, everyday, taxable brokerage account. You don't need your employer to help you set this up. You can just go Schwab, Vanguard, Fidelity, Robinhood. Just go set one up. Now, the biggest downside of a normal taxable brokerage account is that you're not really incentivized in many ways to put money in there. There's not usually somebody matching the money. There's not some big tax incentive. So when we think about the brokerage account, we do have to understand there's a lot of flexibility to it. So there's not like a limit on how much money you can put into it. The investment array out there is huge. You can invest in so many different things. It's going to give you access to a bunch of different investment tools. The biggest problem though is that tax drag. If you're buying and then selling a stock in there, you're going to owe capital gains, and then there's dividends and all these other things that are going to be, the tax drag. Now there are ways to fix that, alleviate that, tax loss harvesting, things like that. For me, it's a solid B tier because although it has those tax issues, I think you can help remedy that if you do know what you're doing. And then just for the fact that it's so flexible, there's really no reason why you wouldn't have one of these set up, just even dormant, just have it at least set up doing maybe something. However, it becomes more specific for the person because for the average person, you're probably better off putting money into an incentivized retirement account like a 401k, where you're not going to be so incentivized to put it into a normal taxable brokerage account because there's not somebody on the other end throwing in money on your behalf. So again, for specific people though, it can be a nice bridge, fill in some of those gaps in retirement. And for certain people, it also might be something that they invest more in than even their normal retirement accounts. And so let's say you max out your 401k, right? Well, then what's next? The brokerage account could come into play at that point. So solid B tier for me on this list, and I think it earns its place there. Okay, the ESOP. So if you're not familiar with this is an employee stock ownership plan. So ESOPs are interesting because you're basically you're kind of going all in on your employer stock. So if your employer stock does really well, you might make a crap ton of money. But if it doesn't do well, then that's a big problem. So this is kind of a high risk, high reward thing for a lot of people. And I've seen some plans do really well, and I've seen some plans do really bad. So this one's interesting. You could argue it's a niche thing because for most people, it probably doesn't make sense. But again, your employer is either going to just offer you it or not, and you're probably just going to be enrolled in it. For this one, I'm going to go with niche just for the fact that it really depends on the employer stock. It depends how the employer stock does. And for most people, it's probably not going to be something your employer even offers. Now, if you did offer this, and if I just had to give you something outside of niche just for the fun of it, for me, it's probably a C tier just for the fact that it is kind of a gamble, right? We just don't really know what's going to happen with that employer stock. And that, from a planning perspective, that's a big problem. But if your employer stock does amazing, then in your eyes, that's an S tier, right? So again, it really comes down to what happens with the employer stock. So for me, I feel pretty comfortable just putting it in niche. Not for most people. It's definitely an interesting one. And if you do have an ESOP plan, let me know in the comments. I'm interested to hear how it's doing for you. Because I'm assuming, we've had a bull market for how long now? I would assume that would, a rising tide would maybe help your employer stock. But that's not always the case. Even in a bull market, I've seen many employer stock plans where the stock just doesn't go anywhere. So yeah, definitely an interesting one, but I'm going to be safely in the niche category for that one. The cash balance plan. So this one's a little weird. You probably haven't even heard of this one. This is one of those weird like defined benefit plans, but it kind of acts like a defined contribution plan, kind of like a hybrid plan almost. This one's definitely going to go in niche because if you use it correctly, it can actually be very powerful because you can just load these accounts up. But again, this is not one of those accounts that you're just going to go out there and create. It's either going to be offered or like a business owner is going to create this. If it's done correctly and it's the administrative side of it isn't too burdensome, I could definitely see this being like an S tier account. But again, for the average person, you probably haven't even heard of one of these and you're never probably gonna be offered one of these. So let's call it niche and let's just move forward. The solo 401k, I actually really like solo 401ks just for the fact that, if you're a business owner, and this is more for people who don't have employees, say you're just a one-man shop, right? And you want to save for retirement. What is the best way to do that? The solo 401k can be a great way because you're basically going in there and saying, hey, I can act as the employee and the employer. So, when we think of a normal 401k, you can put up to $23,500 as the employee deferring into that account. Same thing with the solo 401k. However, with the solo 401k, you can also act as the employer. So that lets you go even higher up to that $70,000 limit, or I believe 25% of your net income of the year. So again, higher contribution limits, generally speaking, especially if you're a higher earner solo 401k. It really is a great account. The biggest problem with the solo 401k, it gets kind of annoying trying to administrate these things just because even the big brokerage firms don't have it totally figured out because there's some weird IRS guidelines on this. However, for an account, for me, I think it's A tier. You could even argue S tier, honestly, just for the fact that it is so powerful. However, there are some things holding it back, mainly just the administrative side of things. But if you find a good plan administrator that kind of takes care of some of that headache, it probably could be an S tier for you. But for now, I feel pretty confident in A tier. And if you're somebody who, has your own business, like a one-man shop, and especially if you earn high income, check out the solo 401k because this might be a way you can just load the boat in your employer retirement plan, and you might be really missing out if you're just sticking with like a simple IRA or something like that. So check it out. It could be a huge benefit to you in your retirement. 529 plans. So 529 plans are state administrated and they are meant for education savings. They're not really meant for saving for retirement. So this one is kind of interesting because if this was a tier list about education savings, this would 100% be S tier. You get that tax deduction, and then you also, when you withdraw those funds for qualified education expenses, it's tax free. So that's huge. It would be S tier for that case. However, since this is a retirement video, this is going to be more in the niche now for most people just because this is for retirement, not for education savings. But if you are somebody who is interested in saving for, a child's education, then a 529 plan is a great idea. Again, these are administered by your state, so I would check to see exactly the type of plan they offer and the different rules around them. But here in Iowa, they are absolutely wonderful, and I would have no qualms putting them in S tier if this was, that type of video. But it's for retirement, so it's going niche. The HSA, okay, the HSA is a health savings account. Again, this is a very, very good account. It's really triple tax advantage. So basically what you use it for is for qualified medical expenses. So if you do that, you do it right, you get a tax deduction going in, you get the tax-free growth and then the tax-free withdrawals. So for qualified medical expenses. So, if it's done right, it really is S tier. I don't really want to put all these different things in niche just because I don't think that makes a fun video. It's going to be S tier for me. It's triple tax advantage. It doesn't have the biggest contribution limits, but in reality, especially in America, you're going to have some medical expenses. So if you can use the HSA correctly, it makes a huge, huge difference. And again, that's the health savings account. If you have one, it's probably because you have a high deductible healthcare plan. And again, not everyone's going to qualify for it, but if you do, you're missing out by not contributing to this and investing that money. So please do that. Look into the rules and eligibility if you aren't already signed up for one. And if you are, put some money in there. You're not going to regret it. S tier. Money purchase pension plans. So these plans are a little weird. You probably haven't heard of these. These have actually accounted for, I think, 0.6% of defined contribution plans in the last few years. So they're rare. You probably never even heard one of these. Funny enough, it's not actually a pension, right? A pension is a defined benefit plan. And this is technically a defined contribution plan. There's some fixed, employer contribution rates going along with this, which is a nice upside. However, it's just one of those things you've probably never heard of. It can be nice because it's a bit more predictable and things are a little bit more forced in this plan than say like a profit sharing plan. However, for me, this is gonna probably have to go in the niche category just for the fact that sure, it could be maybe a C or a B. However, just for the fact that it's so little used, it's not like it offers anything that great if you end up making one or your employer has one. It's just not for most people. And even then, if you found a weird niche case for it, it's still not that good. So let's keep it niche for now. Non-qualified deferred compensation. So again, this is one of those weird ones you probably may not heard of. Generally, this is going to be like for key employees, so executives, things like that. People that usually have these, they might already have like a 401k set up through their company. And this is basically the company saying, hey, stay with us for the long term. Here's something a little bit of extra to keep you in-house. That's going to put it in niche category just for the fact that most people aren't going to run into this because most people are not executives. If you are an executive, or you're a key employee, this could probably sit somewhere in between like C and B. It really depends on the specifics. You can put a ton of money into them and defer them into a lower taxable window in retirement. The bad thing about them though is that you're basically an unsecured creditor with them. So if your company goes insolvent or something, you're not first in line or very high up on the list to get your money back. So you gotta be very careful putting money into this because you are kind of relying on your company to still be around and funding these things. So for me, it's gonna be niche, but if you are an executive, I could see C or B tier. Pensions. So again, pensions are one of those things where you either are gonna have one or you don't. And if your employer offers one, you're probably pretty happy because in pensions, you're basically saying, hey, I'm gonna get a guaranteed lifetime income and your employer is gonna fund that. And they're gonna fund it through these contributions. And then it's gonna be, these actuaries are gonna make sure that there's enough money in the accounts. And there's also some, I believe, government backing where if for whatever reason there's not enough money in there, the government can step in to help fund it. So for me, the pension is gonna be S tier. And I know it's going to make a lot of people happy to hear about this. The only downside is you don't really hear about pensions too often anymore. They're more of a thing you heard about from yesteryear. So if you have a pension, consider yourself lucky. And now that doesn't mean all pensions are necessarily created equal. But if you have a good paying pension that's going to pay you a certain amount of money for the rest of your life at a certain age, yeah, that's a pretty good thing nowadays. So for me, pension, I'm going to give that a solid S tier. Roth IRA. Okay, the Roth IRA is a great account. If you don't have one already, you really should look into this because this is where you can put after-tax dollars into a Roth IRA. You can contribute to one, and that money is going to grow tax-free. And when you withdraw that money, tax-free withdrawals. So, in retirement, and that's a big deal. You can literally load these things up to be 7 figures if you do them early enough. There are, of course, downsides to the Roth IRA. It's not perfect. There's income limitations where if you make too much money, you might have to do it back to a Roth IRA, which really isn't that hard to do. And then also, of course, you can only put $7,000 per year into a Roth IRA for 2025, or $8,000 if you're 50 or older. Again, a very, very solid S tier. If you don't have one of these, especially if you're young, if you have earned income, which is one of the qualifications for a Roth IRA, stop watching this video and go make one, because you might be missing out on one of the most tax advantaged accounts out there. And there's a reason why the government only lets you put $7,000 in there, because they're not going to get a ton of tax money out of this, right? You could be potentially getting a whole tax-free harvest off that seed that you're planting today. So please, 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 if you qualify for one, set one up, look into contributing one. You know, if you're looking to like low cost index funds, because for the love of God, don't just put money in there and let it sit in there. You have to put the money in there and then invest the money in there. So there's 2 steps there. Set up the account, put the money in there, and then invest. 3 steps. S tier, no doubt. Rollover IRA. So the rollover IRA, it's really nothing special. Most of the time with like a traditional rollover IRA, what you're doing is you're just, say you have a 401k from an old employer and you want to move it to an IRA for more flexibility and have more control over those investments. You may use a rollover IRA just to send that money somewhere. Really, it's not really a bad account in many circumstances. It's nothing too special either. The biggest problem with the rollover IRA is that if you are trying to do the backdoor Roth IRA and you have a rollover IRA somewhere just sitting out there in no man's land, it messes that up because of pro rata rules. So if you're going to do a backdoor Roth IRA, be careful that you don't have these other accounts sitting out there because of the pro rata rules. But in terms of a retirement account, it's probably going to be a C tier. It doesn't really do anything too special. It's not like it's super incentivized or anything like that, but it's not going to cause you a lot of issues either. Chances are you probably are going to set one of these up at some point just to transfer money from like an old employer plan that you left hanging at the donut factory that you used to work for or something crazy like that. So again, I put it at a solid C tier. Profit sharing plan. So profit sharing plans are interesting because basically what the company is trying to do is say, hey, we're all in this together. The better the company does, the more money, that profit we can all share and distribute out. I've actually worked for a company many years ago that did profit sharing, and it was really nice. However, when there's not a profit sharing check, it's like, oh, well, that sucks, right? So for me, it's probably gonna be, it's not S tier. I'm gonna give it A tier. Usually you're gonna see these things attached to like a 401k. So you're gonna have a 401k with a profit sharing provision in there. And it's a pretty nice thing to have. I mean, the fact that you feel more cohesive as a company and as an employee, that's a generally good thing. Of course, there are some of those downsides that I mentioned. But again, I don't think I've heard of many people complain about this. Usually they're pretty happy when their employer has this. So for me, I'm gonna give that a solid A tier. It's a nice thing to have, and it's not as risky as like an ESOP plan, but it also doesn't have as much reward. The Roth 403b. So let's talk about the traditional 403b first. So this is very similar to like a 401k, but generally this is going to be for like your nonprofits or your folks that are working like for a school. This is a very solid account. You can get the employer match, things like that. They also have some special provisions in there, like a special catch-up provision as well for extra contributions. For me, this is going to be a solid A tier. Actually, this would be S tier because this is the Roth version. So for me, I think the fact that you have the ability to put Roth money into that is even just the extra icing on the cake. I know for the traditional 403b, I might as well just grab this one right now. For me, that's going to be A tier, just for the fact that it's also a great plan. But the fact that you can do a Roth version of it just makes it even more special. So if you have one of those, contribute to them, get that match if you have it, and really put these accounts to work because they may be the main account that you use to retire on. Roth 457b. So let's talk about the 457 first. So the 457 is generally going to be seen by more of the government employees out there. It's a very solid plan, and it's often actually the exception to the rule when compared to like a 401k and a 403b, because it kind of has some weird, quirks to it. So the biggest one that you're probably going to notice is that the 10% early withdrawal penalty actually doesn't apply to a 457 plan in certain circumstances, which is a really nice thing and can help with those early retirees out of the 457 plans. However, there can be some strict rules with them. It just really depends on, if you're a government employee and what exactly they're offering. Again, with the 457, I would say, you're looking at, for the Roth version, I'm going to say that's S tier. And then for the regular one, traditional one, I'm going to put A tier, just for the fact that I do prefer to have at least a Roth provision in there to be more flexible with how I want to fund things. Outside of that, though, a big benefit of the 457 is that you can, if you have a 401k somewhere else, you can max out a 457 and you can also contribute to a 401k. So they don't have a shared contribution pool. Whereas with other employers, let's say you had a 401k and a 403b for whatever reason, you put money into one, you're filling the bucket up for the other one, okay? So it's one of those things where it's often the exception to the rule instead of following this kind of norm that we've established with the normal 401k, 403b, which makes it unique and kind of fun. So again, let's go with S tier for the Roth 457 and then A tier for the normal traditional 457b. While we're on the topic, the 457f, this is again one of those retention tools used as sort of like a golden handcuffs for like executives and key people to keep them there at the company or the government. And this is one of those things that you're really not going to see too often. It's going to be definitely a niche category. There's some weird things about these things. One of the biggest ones that I've noticed is you actually are taxed on these things usually when you're vested. So you might have this thing you might have to pay taxes on when you haven't actually received any money from it yet. But again, the upside of that is being a non-qualified plan is that these things can just be loaded up. So maybe the government thinks you're very special and they want to keep you around and they might give you one of these as a retention tool. They might load it up, but you do have to be careful with the tax bombs. However, there are a lot of great benefits and we're niches about it. So if you get one of these, really know the rules, really talk to your employer about it, make sure you understand what's going on, because they can be really great or they can just kind of, blow up in your face. So be very careful. SEP IRA, so that stands for Simplified Employee Pension IRA. This is one of those accounts that you could just put down as a niche category because you're probably not going to see it. But if you are someone, say a one-man shop trying to set up for retirement, it is a good way possibly to get those higher contribution limits. However, I would prefer just like a solo 401k or something like that. If you have employees, it gets messy. Roths I don't even think are allowed for this at all because I think it's more like a traditional IRA in the sense how it's set up. For me, at best, it's C tier. I could maybe see B or A for the right person, but I think there's just better options out there. So you could argue either C tier or just niche and not for most people. But again, I don't want to fill the niche bucket up too high. I got to make this kind of interesting. So let's go ahead and go with C tier for the SEP. Annuities. So annuities aren't really like a retirement account. This is more of a product. It's usually an insurance product. So I just don't like these things. I mean, there's so many weird things like surrender charges. They're wrapped up in all these beautiful little bows and boxes, and then they get you with a surrender charge or a contract, stipulation. These things are even being tied to like index funds to make them sound more appealing than they really are. Again, outside of some more niche circumstances where maybe you want like fixed income from an annuity, something like that, then I can see it making sense. But for the average person trying to decide where they should put their next dollar for retirement, annuity is going to be way down there. It's going to be a D, possibly an F tier, just because these things really are made to make insurance companies money. They're not really there for you to make money. However, if you need like a fixed income or like a reliable source of income, annuities can be a very good thing. And I know this is going to piss off a lot of insurance people off out there, but they get prettied up. It's kind of like a pig with lipstick on it. A lot of these are. And then you have like the variable annuities, which are like these semi-investment things with insurance, underpinnings. I just don't like them. And it's not that I don't understand them because I've actually researched annuities a lot. It's just one of those things where I found the devil is in the details of these things. And for most people, you're better just sticking to something else. SERP, so this stands for Supplemental Executive Retirement Plan. So kind of like we mentioned earlier, this is actually a type of a non-qualified deferred compensation plan, the NQDC. This is going to be almost identical to that one. So it's going to be a niche. It just really depends. for the executives, key people, can blow up in your face, but also can be a really great things for employee retention, executive retention. But for most people, it doesn't really, something that you're not going to see. Simple 401k. So the simple 401k is an account that usually you're going to see with an employer with less than 100 employees. As the name suggests, it's a bit easier to set up for them. You know, you might have a small team that you want to have a 401k for, but you don't want this crazy administrative burden on you. There are going to be some good and bad things about it. So the good thing is the employer is required to contribute to this. I think it's like 2 or 3%, depending if it's non-elective or elective or not. So that's nice for the employees. And then, you know, the downside though is you aren't going to be like really using this as like a maximizing retirement account. It does have a lower contribution deferral limit for the employees. I believe it's $16,500 for 2025 compared to $23,500 for the, you know, like a normal 401k. Again, compared to like a solo 401k, you know, it's not going to be as nice, but it's kind of, it's a different thing. It's meant for like smaller teams. So for that, let's give it a solid B tier because it does some things pretty well, but I wouldn't call it one of the best accounts out there. A simple IRA, so, you know, kind of the same idea as like a simple 401k, where basically you're trying to go in there, provide some type of retirement plan for your employees. Again, this is going to be on the smaller team, less administrative issues. For me, it's going to be right next to simple 401k. Similar, you know, contribution limits on the deferral side for the employees, $16,500. Employee, I believe actually all contributions are immediately vested. And I believe also the employer is required to contribute to these accounts. So yeah, it's nice if you just want a simple plan, set it up for your employees, nothing too crazy. I could see somebody going into one of these. However, for somebody trying to maximize retirement or like, you know, by themselves, a solo 401k would make a lot more sense for them. Overall though, pretty solid starter plan. Traditional IRA. So the traditional IRA for me, you know, this is one of those things you just can set up on your own. And while you may want to set one up, I find for most people, it's not going to be a super useful account for retirement saving. You know, the main benefit is that you put money in there, you get a tax deduction, which can be very nice for high income earners. Because unlike like a Roth IRA, there's not income limitations to put money into a traditional IRA. But the downside is a Roth IRA for most people is a lot better. And the fact that you can do a backdoor Roth IRA is probably the main benefit or main reason why most people even have a traditional IRA is as a stepping stool to use a Roth IRA. You know, outside of that, you still have the RMDs, which is going to be super annoying. Of course, you can only put $7,000 into these per year as of now, $8,000 if you're 50 or older. And if you're putting money into a traditional IRA, that has a shared, you know, bucket basically with the Roth IRA. So if I put $7,000 into a traditional IRA, I cannot put in $7,000 into that Roth IRA. And on the deductibility of a traditional IRA, if you have a workplace sponsor plan like a 401k, that can cause issues where you may not be able to deduct that for that traditional IRA contribution. So for me, it's going to be in C tier, just for the fact that it has some of those issues. But for some people, some high income folks, it can make sense to get the deduction. However, I just find in reality, there's a lot better ways to get a tax deduction than a traditional IRA. TSP, so this stands for Thrift Savings Plan. And generally, you're going to see this for federal employees or some military personnel. These are really nice accounts, and you know they can come in the Roth form as well. Very similar though to a 401k, provided in the private sector. So you're going to have that same contribution deferral limit, the $23,500. You might get a nice match on it. So for me personally, this is up there in S tier, just for the fact that if you have a nice match, you really do want to put extra money into it. A lot of nice benefits like a 401k. This is just more of the federal employee military, flavor side of things. So yeah, really great account, and definitely an S tier. Roth 401k. Okay, these are great. So this is just very similar to a traditional 401k, but you're using after-tax Roth dollars. This is going to be a solid S tier. The main benefit of this compared to like a Roth IRA is that you don't have those pesky income limitations, those RMDs, those required minimum distributions. You don't have to worry about those. So if you have a Roth option in your 401k, you really do want to consider, contributing to that side of things. If you have a really high income though, then a traditional 401k, that current year tax deduction, that's nice because, technically it's not like a line item deduction on a traditional 401k, but the fact that you're reducing your taxable income is a huge reason why people with higher income may want to forgo the Roth 401k and stick with the traditional 401k. However, I think for a lot of people, they'd rather just put money into the Roth or 401k, let that sucker grow, and then when they take that money out, you're gonna have those tax-free withdrawals as long as you're meeting some of the qualification rules. And for most people, that is a solid win. So for me, it's gonna be a solid S tier. If you have one, you really should consider contributing to it. And lastly, the 401a. So the 401a is going to be offered by more the government and the public sector. This is one of those things that I would put in A tier, pretty similar to like a 401k. The main difference between a 401k and a 401a, besides the type of employer, is the 401k is a little bit more flexible in what the employee can do, whereas the 401a, they're kind of the employer, usually the government, has a lot more control over it. So they're going to really tell you how things are done. The investments, might be a lot more limited, but then that can be a good thing depending on what exactly is going on. But again, a very similar idea to the 401k. All right, you guys, that is all that I have for today. I really appreciate you sticking around and watching all the way through on this tier list. Taking one last good look at my tier list here, I think I have it pretty good. I think we have everything just about where it should be. Of course, this isn't like a perfectly exhaustive list, but I thought I got most of them. And of course, this niche category is going to be highly dependent on the type of, employee you are and the employer, all these other things. So you can't consider this video as a one size fits all. There's so many nuances going on here, and you shouldn't take this as, oh, I should invest in one thing over the other. This is just my general feeling about how I feel about these different retirement accounts. So again, personal finance is personal. Stick to what's best for you. Don't worry too much about what I tier list these. If it's working for you, that's great, but I just want to give you my general opinion. That's all I have for today, guys. Again, thank you so much for watching, and I'll catch you in the next video.